Taking a look at the charts, equities are trading slightly lower this morning. We do have fear carrying over a little bit from yesterday. We saw the VIX have a pretty good pop up about 11%. And today the VIX is up another 7%. So fear is starting to creep up. I shared this in the evening update yesterday that the VIX is moving up, but we haven't seen the put call ratio spike yet. And we haven't seen panic selling kick in. And typically the VIX I find spikes first. And then we start to see panic selling, and then eventually we see the put call ratio spike, which is once the panic selling kicks in, that means people have sold their positions. Whoever was going to sell is now panicked out, and then they go and they buy put options to bet on falling prices. And so once the fear kicks in, then they liquidate positions, then they bet on a falling market. That's typically when the stock market puts in some type of pivot low. So we'll see if we get some of that today or potentially Friday. Keep in mind, let me just pull up, we do have, the markets are closed on Thursday. President Jimmy Carter passed away, so we are going to, the markets will be closed. And just to recap on a quick question there from members yesterday in the afternoon update, the stock market has potential to rally about another 11% with the QQQ. And a member was wondering, well, will the US dollar continue to go up even if the stock market goes up? And so I just wanted to show a chart of, as the top here, you can see the QQQ, very big rallies over the past year, and the dollar has also rallied during those times. So it can totally happen. Now, there was a big gap, a big move down on the UUP ETF. Some of you are wondering about that. That is a dividend payment. So really, whatever it drops, percentage-wise, it was big. It was a 4 or 5% drop. You get that paid out in cash into your bank account if you're holding positions. So you don't take a loss. You just get a cash deposit for the difference into your account. All right, so let's jump into the charts here real quick. So the stock market is moving down today. Fear is creeping over, and as I've talked about before, when there's global fear, we tend to see people liquidate, and we tend to see the reserve currency do well. We are seeing the dollar index move higher this morning, which you can see on the daily chart here, having a very nice pop, up about 0.6% as people are liquidating and moving currencies and trying to protect their capital. We are seeing gold trade slightly higher as well as a defensive play, moving up a little bit. Again, I do expect gold to continue to hold its ground or move higher over the next month or two. It could go up and a little bit higher, but keep in mind, for some reason, everybody keeps getting this confused. They're saying I'm giving more mixed signals. Short term, I think gold can go sideways or higher. I don't think it's going to take off, but I think it could go back up to those highs, maybe poke to nominal new highs. Longer term, when the bear market kicks in later this year, I think gold will have a much deeper correction. Could come back to 2,300 or even 2,000, somewhere in this range. That's typically what happens when panic selling hits the overall market, and there's margin calls and all of that stuff. All right, let's take a look at the bond market. Bonds are down again today. Fund managers are moving away. Everybody keeps trying to pick a bottom in bonds. It has been in a bear market pretty much since the spike in COVID, where we got out literally at the spike high for a 19% gain on our TLT trade. And it has been trying to carve out a bottom. It looks bottom-ish, has for a long time. But this is a huge bear market phase, and it needs to build out this stage one, this basing formation, and it could continue to go lower. And that's what's been going on. We had a trade. If we take a look at the bond market and the equities market, we were along the bond market. Looked like bonds were about to go up. It met the criteria. We got into bonds, and then about a week and a half later, our strategy in the market was saying, hey, get out of bonds. Tides have changed. Get into stocks. We rode the QQQ up for a very nice gain. And bonds are down about 13.5%. That's a 23.5% spread between changing positions. And why it's so important. I know some of you refused to get out of bonds because it was such a quick trade. We got in, a week later we're getting out. And I know how painful it is, 13.5% loss on a bond trade. It just goes to show the importance of rotating to the asset of favor. Where money is flowing, we want to follow it. If you don't do it, you can do so much damage by refusing to get out and taking a small loss. Taking 1.5% loss and then moving into something that goes up 10% is a huge difference than just holding on and riding it out. And so it's really important to follow strategies and things like that. So anyways, bonds are going to continue to be lower this morning when we look at the charts. They are in free fall mode yet again, not acting as a safe haven. In fact, this year could be another year where bonds flatline or go lower and the stock market continues to fall. So both sides, if you've got a portfolio with stocks and bonds, you could get hit very hard. You don't have anything protecting you. And that's the whole point of our strategies here is we move to something that goes up while the stock market goes sideways or down. Let's go take a look over at oil. We do have oil's had a little bit of a bounce and rally here over the last little bit. Has been kind of hanging out at this really critical pivot point. If we just draw a line across here, oil has been holding above there. If we go way back in time, you can see this is a very important level where we were kind of above it, traded through it. Many times it found support, kind of got through. Really just in the last several years right through here, you can see how you're either stuck above it or below it. And really at this point it's just having a bounce up. We've got kind of really rough falling trend line. It's up into resistance. I wouldn't be surprised if we see selling start to kick in. Overall, we've seen a bounce there, but if we take a look at energy stocks have been hit pretty hard recently. They're big dividend stocks. A lot of people are in them. They've had that bounce up. We talked about how this looked like a panic selling washout about a week and a half ago and how it looks like it's ready for a bounce to the 20 or 50 day, which now it more or less has done so. And if we just kind of draw a line between those, you can see it's fairly significant area on the chart where it's acted as support, lots of trading and pivot lows and highs through here. So I think it's going to run into some resistance. Now, ExxonMobil came out with earnings, and I don't know what the stock price did, but they weren't good. And that's probably because oil prices are low. It looks like it's a little bit under pressure this morning. Nothing too significant, but overall, we're just not seeing a whole lot. And this is the problem, is dividend stocks, a lot of them are energy. If oil drops, which I think it's going to get down into the 50s or 40s, energy companies are going to have slow earnings, which means they're going to start cutting dividends, and then there's forced liquidation. Certain funds won't hold stocks if they don't have certain dividend levels or don't have any dividends. All this is going to snowball into kind of a big scenario that I've walked through many times before. Also, some news came out with Germany with factory orders dropping again. This is something I covered in a talk when we were covering where all the job cuts are going. And if factory orders are dropping and there's job cuts there, is not a good sign. That means we're like 3-4 months out for another wave of probably poor economic data. And of course, that could trigger into the energy space. If the economy is slowing, oil will break down, energy falls, dividend stocks sell off. Take a look at the dividend stocks. This is the SPYD. This is the high yield dividend stock. So this is the majority of what investors hold. Big move down. It has this potential very high momentum tight bear flag. I don't even want to draw the downside target for this using Fibonacci extension. This is a very high momentum move that we could see another huge drop, another 9% drop or so in this space. So that would be that'll be like a almost 20% drop for holding dividend stocks. And could get pretty ugly. Not saying that's going to happen just yet. This might want to bounce up a bit, but overall, money's moving out of dividend space, and definitely we're seeing fear. Overall, if we quickly look at the 30-minute chart here, we've got FOMO buying. Whenever we see FOMO spikes, we tend to see short-term market high. You can see over here we had a FOMO spike, and then we saw the market fade down for a session. We had another FOMO spike. The market faded down. We had another one. This was that big gap we talked about the other day. It was on Trump news with tariffs. Everybody piled in. We saw everybody buy into all the aggressive stocks, and pretty much they all bought in near the highs, and then we saw it start to sell off. Now, yesterday we saw another gap up. We saw FOMO buying, people jumping in, and then, of course, the market sold off again. So not the best looking chart pattern. In fact, if we go and we take a look at the SP 500 daily chart, you can see we have somewhat of a bearish pattern here. We've got the market's moved down. It's got this kind of pennant formation, which is pretty ugly. The moving averages are still holding up, but not looking the greatest. This could break to the downside and create a sell-off. Also, if we take a look back over here, we had the same type of thing. We had another pause. Moving averages were starting to converge and cross over. And then we had that big flush out in July. So we could be coming into another standout low panic sell-off in the markets where the VIX spikes. We see panic selling spike. Could create one of these standout lows on the chart. Let's just actually go back and see if we can. If we go back, we have these. Let me see if I can zoom in here a bit. More or less, our panic selling indicator when we have a level up at 6 or 7 up in these big levels here. If we take a look at NVIDIA, pretty gnarly looking bar. We came up to these highs, tagged these highs, maybe even pierced it by a penny or 3. And then we saw a huge selling step in yesterday, a big reversal bar. You could argue this could be a little bit of a short-term double top, but that is not an overall good sign. This points to, it might have a little bit of a bounce today. That's just such a huge drop. There's going to be bargain hunters saying, hey, it's a steal right now. So it might create a little bit of a bounce, but overall, that's not a good sign. Usually points to lower prices going forward. Last but not least, if we take a look at Bitcoin, down 0.75%, it's had a little bit of a bounce and rally as well, and then a big reversal bar there yesterday with huge selling. And this is what we talked about. Bitcoin hit our 100% measured move. If you were in that trade with us, we got out pretty much right at the high, and then big selling stepped in. And now you can see these last 2 days here are big selling as well. So this was just a pause, a little complacency move or a bear flag, and now we could see another deeper leg down in Bitcoin. Anyways, that's it for now. We'll talk to you soon. Bye-bye.